Good morning to all of our viewers from across the US. It is July 7th, 2021, our first broadcast here in the new year. So, first of all, before we begin, I just want to wish everyone a fantastic and happy New Year's. Certainly, I know there's going to be a lot of people out there that are excited and happy for 2020 to be over and are looking forward to a fresh start. But the good news is, of course, is that there was a lot of great lessons for all of us in 2020, whether it was from an investment perspective or more importantly, of course, to covet, the things that we truly love and care about, such as our friends and family and our health. We can invest and create growth for our clients. But if we don't have our health, then none of that matters. And I think 2020 was certainly a year that brought a lot of that into perspective. But the good news across all of this, the silver lining, is that overall, when we look back at 2020, from a growth perspective as it relates to our investment strategies, we were able to execute and deliver solid performance across the board. And then I actually think more importantly was the fact that we were able to learn a lot of great and fantastic lessons in the investment world in 2020. And what were those? One of those were patience and not getting distracted by noise, right? There was so many opportunities to get distracted, for us to lose our focus. And I'm so glad to say that all of our clients, all of our advisors, our team here at Life Pro stayed focused, right? We didn't let the noise of DC, we didn't let the noise of the COVID outbreak, we didn't let the noise of global recessions distract us from focusing on investing and partnering with companies that are leading positive disruptive change and leaders in innovation across the world. That's what we're here for, right? That's how we grow client account values over the long term. We want to target and invest in disruptive and innovative leaders across the world. And that's what we did in 2020 and what we hope to do in 2021, 22, and beyond. So, one of the things that we want to talk about today is that disruption is accelerating, right? We hear a lot of questions. We hear a lot of rhetoric around, well, we want to rotate into value and we want to rotate into the old guard stocks, as we call them. In other words, the companies that are being disrupted. And that might work for 2 or 3 weeks, but long term, you always want to be on the side of disruption and the companies that are actually doing the disrupting, not being disrupted. So that's a key message today. So the 3 takeaways for this week: the stock market doesn't care about politics. Yesterday was a travesty in terms of what happened in DC, right? We know that whether you're on the right side of the aisle, you're in the center, or on the left side of the aisle, we all have our views and we all have certain passions politically, but certainly, having that sort of disruption in our nation's capital doesn't look great for the country. But the good news is that for the market and for stocks, it doesn't matter. It's a giant distraction. We have to remember that our money doesn't have an ideology. Our money doesn't have feelings. Our money is basically a group of nihilists, right? They have no beliefs, right? Money doesn't have beliefs. It is cold-hearted, and it is simply going to gravitate toward the areas and assets that are going to generate the greatest return for the lowest amount of required risk. And so that's really the way we have investing. The second thing, free money does not convert a bad business into a good business, right? So yesterday we saw a big rotation from secular growth into so-called value, right? And to us, value, it means a stock that offers fantastic growth at a reasonable price where we can actually expect to generate above average returns for clients. Value does not mean a stock that has underperformed because the business is bad. And then suddenly we're going to see a catch-up trade. A bad business is a bad business until a new management team comes into place, until the fundamentals turn around, and until we see earnings and cash flow increase. So hoping that a bad business suddenly converts into a good business because we get stimulus checks or we have an economic recovery is not something we focus on or hope for. We're going to stay focused on long-term secular growth. The last big message, Tina. Now, a lot of people are going to say, "Well, we made this acronym up because my wife's name is Tina." Absolutely not. Tina is this idea of there is no alternative, right? So money's going to gravitate toward the asset class with the highest potential return for the lowest amount of risk. We have, from a liquidity standpoint, 4 basic areas we can invest our money: stocks, bonds, real estate, cash. Right now, from when we look at 0% interest rates, and we look at the full valuation of real estate in the US right now, and we look at really, the zero value we're getting by holding cash, stocks remain relatively attractive versus other asset classes. And until that dynamic changes, I think you're going to see the stock market be quite resilient through the noise in DC, through uncertainty as it relates to the economic recovery, all these other factors that can distract us. Until that dynamic changes, the stock market and, of course, individual stocks are going to remain resilient and gravitate higher based on our homework. Now, a quick performance review here. We ended 2020, when it was all said and done, up 101.05% after fees, which put us ahead of the S&P 500 by just under 85% after fees. So certainly when we look back and say, did it make sense for our clients to pay a little bit more in fees, but not be invested in a low-cost index product from whether it's Vanguard or Fidelity or the prevalent index providers out there? We would say in 2020 that answer was absolutely yes. And we look back through history, whether it's through 1 year, 2 years, 3 years, 4 years, and onward, we've certainly been able to deliver that value. Is that a guarantee on future performance? Of course not. But our focus remains steadfast to be able to continue to generate above average returns relative to a low cost index product. We look back to inception, up 227.62%, outperformance of just under 160% versus the index. So again, that's our focus. If that means changing companies underneath the surface, so be it. But we're going to look for a collection of companies that we believe, based on our homework, can target and achieve above average returns relative to a low cost index product. And what has that meant from a dollar perspective? So if a client had invested $1 million with us back in 2017, today, dollars after fees, versus if they put in the index of 1.68 million. So again, these are real dollars, real consequences, and it does make sense to have an active approach to investing if you're partnered with a team that keeps you in the loop, is transparent about what they're doing, and of course, they're able to actually achieve what they're hoping for. And so far, we've been able to do that. Now, as we go into 2021, what are our core investment themes as we look across the market? A lot of this is going to look consistent with a few different changes here. So mobile e-commerce obviously was an explosive year for mobile platforms, for cloud-based platforms, for companies that are helping people, companies, entities really digitize across the board, whether that's at the corporate level or at the personal level, workflows, commerce, whatever that activity is, being able to help digitize that across the cloud, on your phone, your desktop, whatever that action is, being able to digitize that across the board. That is a theme that we're going to continue to see to play out, not just in 2020, but in 2021, 2022, and beyond. We're not going backwards just because the economy is going to reopen at some point, right? We're not going to suddenly say, you know what, all those savings and value that I achieved by shopping on Amazon, I'm going to now go back to shopping brick and mortar and pay a little bit more in price. No one's going to say that. What a crisis like COVID does is that it increases the adoption rate of new technologies for people that otherwise were perhaps hesitant to adopt. And as that adoption rate has increased, those people are now becoming the true cheerleaders for other people who are still hesitant. And so, in other words, that pie is getting bigger, and more people are going to on a recurring basis shop online, conduct business online, and overall become more digital. And so we think that has a lot of staying power. The genomic revolution, if there's one big thing from COVID, aside from the proliferation of e-commerce, it is the proving up of certain technologies such as CRISPR, such as mRNA technology. Being able to develop a vaccine in under 12 months says that this technology is real. That's the key. It's not the vaccines themselves. The vaccines themselves are being sold at cost. Companies are not really making money. It's the proving up of the technology that allowed the development of the vaccine in such a short period of time. The next step is applying this technology to real and actionable diseases with large total addressable markets and that have margin and profits attached to them. So that's really the next thing you're going to see. The e-gaming economy, right? Whether we're talking about sports betting, whether we are talking about video games, and the way that we interact with video games, whether it's watching other people play video games, betting on video games, believe it or not, this is a huge and proliferating market, and we want to be part of it. Millennial brands, of course, for all those brands that we're aware of, old brands that came up through the baby boom generation, quite simply, the younger generations do not want to shop at those brands. They want new experiences. And we're seeing that continued disruption and market share disruption across the board. And of course, ESG-driven business models. What do we mean by that? Whether it's the proliferation of vegan consumption, right? So low carbon intensity food consumption, or if we're talking about energy, right? So the idea of renewable energy versus carbon-based energy, that will continue to be a theme. Now, regardless of whether you believe in it or not as it relates to the political dynamic around that in DC, it is here to stay, and we want to be focused on it. We want to help our clients make money from that overall movement. So what is that? How do we go about this? So a lot of people ask us, well, your technology weight is higher than usual. We say yes and no. What we look for are solid businesses that are well managed. And then they effectively use technology within their sector to achieve massive scale. And I think that's the key here. Amazon's not a technology company. They are a consumer company that effectively uses technology to create massive scale and a platform type of business. And that's what we're looking for across the board. Real quick here, please remember November. It was only 2 months ago that we warned clients, we coached clients, and I think successfully coached clients as we had close to 100% retention rate prior to the election, that politics don't matter. Politics don't matter. And for those who heeded our advice, the stock market had one of its best months ever in the month of November. That's not because they suddenly liked the incoming investors suddenly liked the incoming administration. It was just that, hey, this distraction is out of the way. We can focus on the fundamentals. Same thing this week, right? Georgia election, chaos in DC. Please ignore it. It's a distraction. And there's a reason why the stock market today, as we're talking, is up quite a bit. Because again, it's another distraction removed, and we can now focus on the fundamentals. And guess what? We don't have to deal for an election. An election for another 2 years. Thank you, thank God, because it's a giant distraction. So what we're seeing here is basically peak event risk within the market. As we move beyond this last election. What we're now seeing is event risk is coming down, and overall volatility, structural volatility, should be on the decrease, right? So peak election concerns, decreased policy uncertainty. Yes, one political party is in control of all three branches of government, but the margin of that majority is actually at one of its shortest or most narrow in the House that it's ever been. The Senate is essentially a 50-50 split. So the ability to corral senators and pass policy across the board that is extreme is very, very difficult in the U.S. system. So we have to remember that. And I think you're seeing that reflected in the market today. And then, of course, the continued economic recovery and the most important, fiscal and monetary policy support. The biggest takeaway from the election is that $800 billion, $900 billion, depending on how you measure it, fiscal relief package that was just passed, that is likely to be bumped up. And yes, that's going to be more spending, but that's good for the stock market. And that's our job. Our job is not to figure out fiscal policy sustainability over the next 5 to 10 years. That's not our job is to figure out whether stocks are going to go up or down, which stocks to buy, and what is the type of policy environment that's most favorable to them. This is a favorable environment for stocks. So lower uncertainty generally increases risk appetite. Important dynamic to remember. Here, there is no alternative. We talked about that stocks have structural support in this environment when other asset classes are not as attractive as stocks, right? Money has to go somewhere. Kind of think of it as an air mattress. If I press down on an air mattress, that air is going to go somewhere else. So if money's not in stocks, it's got to go somewhere else that's liquid. Cash, bonds, real estate. The problem right now is that bonds are more expensive than stocks, and cash is getting killed through inflation, and real estate is also very expensive at all-time highs. So when we look here at these charts, the percentage of S&P 500 stocks with dividend yields greater than the U.S. Treasury yield is at 63%, the highest it's ever been, right? In other words, where are you going to get more income, from S&P 500 or from the Treasury yield? The S&P 500. So if you're focused on income, stocks are more attractive. And then, of course, total cash on S&P 500 companies' balance sheets is also at an all-time high, right? Cash is king when it comes to balance sheet security. So again, lots of things to like about stocks despite the rally in 2020. And the other thing we would say is there's no evidence of structural froth. We had a partner that put together this list of, what we call sort of a checklist of things that we look for when trying to understand whether the stock market is entering the final throes of the bull market and beginning to enter into a bear market. And the bottom line is we don't see a lot of evidence that we're in the final innings of this bull market. Rather, we actually see evidence that we're in the early innings. So we don't see a parabolic move in stocks. Now, there are pockets. Like if you look at the EV sector, obviously there's been a very strong parabolic move upward. But the stock market as a whole, in the areas that we're in, we have not seen a parabolic move upward in stock prices. And in fact, a lot of stocks have, from a very healthy perspective, been consolidating sideways for the last few months. Money is cheap, low interest rates. The supply of cheap money continues to rise through money printing and low interest rates. That is key. Earnings are recovering, inflation is low, and the credit markets are strong and healthy. All of these points are extremely important to provide stability and support for the foundation of the stock market so that we can continue to move higher as earnings come in higher than expected, as the economic recovery continues to unfold from that, obviously, that March 2020 recession. So again, all of the structural support is there for a healthy and rising stock market. And we always have to do things based on balance of evidence. Now, the other thing is fiscal support, right? So remember, stocks are politically agnostic, right? So what do we have to do when we see the noise in DC? Take a step back and go back to the numbers, go back to the data, right? This is the number, this is the amount of money supply in the system with the chart on the left. Huge spike. When you see huge spikes like that, that money is going to go somewhere. It's seeking return. It's not seeking just to sit in cash. So when you have money supply go up, risk appetite goes up because there's a lot of money in the system, right? If there's 10 times the amount of dollars in the system, the average investor's ability to stomach a $1 drop goes up, right? They can stomach more volatility because there's more dollars in the system, right? So the point here is that when money supply is going up, don't make this difficult. Stocks are going to gravitate higher. And then the chart on the right here, we see right now fiscal policy is projected to be 5.6% of GDP. That's going to go up, right? We know one thing as a result from the election is that we are likely to get a bigger fiscal policy bump here over the next 12 months. So again, that will goose GDP growth. And then of course, the other thing we would mind here is valuations. One of the big bear arguments that we hear about constantly is that, well, the price to earnings ratio of the S&P 500 is historically high. And that is true. But what's also true is that 1 year after a recession bottoms, PEs are always historically high for the stock market. So if we look at 2009, 2010, 2002, 2003, 1992, 1993, PEs were very, very high. Why is that? Because the first step in a stock market recovery is PE expansion. Stock prices move ahead of the earnings recovery. So if stock prices are moving ahead of the earnings recovery, you're going to get a PE expansion because E, earnings, has to catch up to the stock price. So the first step in the stock market recovery is PE expansion. The second stage of the stock market recovery, which is what we're going to enter in 2021 based on our homework, is the earnings recovery, right? So companies that are able to execute on above average earnings growth, those are the stocks that are generally going to outperform in a market environment such as this. So 2 stages, PE expansion, then we get PE contraction, but the E, the earnings growth, is faster than the PE contraction. So very important point to pay attention to as we go into 2021. So overall here, when we look at what we see in the market, we have to remember that the main point here is that monetary and fiscal policy doesn't convert a bad business into a good business. We need to stay focused on long-term disruption, long-term innovation, and the companies that are leading positive disruptive change across the world. Partner with them, grow with them, and create wealth with them. So the pace of innovation and disruption is accelerating. That is an opportunity if we can identify the right companies for our investors. Stocks remain attractive relative to bonds, cash, and real estate until that dynamic changes. It's hard to see a stock market entering into a long-term bear market. And of course, money remains cheap and inflation is low. Those dynamics in place, again, further tailwinds and structural support for the stock market. So thank you. Happy New Year. If anyone has any questions, please contact your advisor. You know, I know last year was a tough year for a lot of people, but we're here to help. And we're here to help you continue to grow your money. Whether you're a new client or existing client, our focus is always on growth. That's the point of investing, is to grow your money. And that's our sole focus here at Life Pro Asset Management. Have a fantastic week. And again, Happy New Year. Thank you for your business. And we'll speak again next week.